In this episode of The Bear Roars, Dan Caruso sits down with David Prichard, CEO of Denver Ventures, to talk about the evolution of Colorado's venture capital scene and the people reshaping it. David shares how Denver Ventures grew from a local angel group into a major investment platform, why the best investors focus on founder DNA over flashy ideas, and how the next wave of Colorado innovation may come from hard tech, quantum, and AI. It's a candid look at what makes great founders tick, why conviction matters more than capital, and how a new generation of investors is putting Colorado on the national map. Let's poke the bear to kick off the conversation.
All right, David, I'm looking forward to this. One of my favorite topics in Bear Roars is the amount of investment activity that is on the ground here in Colorado. There's this mindset that was based in facts, if you look back 6-7 years ago, that there wasn't that much capital formation on the ground here. Handfuls at most of venture firms, relatively small. But in the last 3, 4, 5 years, there's been a significant expansion of investors on the ground here in Colorado, including funds on the ground here and other type of investors. And you're one of them with what you've been doing with Denver Ventures and kind of the platform around it. So let's start by just telling us about your platform, and then we'll get in more to how you created that, and then we'll talk a lot about Colorado itself and the tech scene here and what kind of things you like doing and don't like doing from an investor standpoint.
Yeah, absolutely. Happy to. I mean, Denver Ventures, we're an interesting mix of a few things. We were birthed out of an angel group, Denver Angels. And so we have deep community roots with originally, 100 and something investors. Well,
tell us a little bit more about Denver Angels. So what was, you were birthed out of Denver Angels, but what was Denver Angels? What was its background, and how did that get created? What did it do? What does it still do?
Yeah.
And then how does that help launch the broader platform?
Yeah, my partner Kenny Montfort and Zach May had originally started Denver Angels. I mean, back 2016, and it was just a open pitch platform at that point, like pretty typical dynamic. And I got involved and partnered with them along with at the time another gentleman, Paul Foley. And we all threw in together in late 2019.
Yep. And tell us about each of these individuals.
Yeah. Happy to.
Tell them who Kenny is.
Yeah. So I mean, Kenny Montfort. Kenny, his family owns the Colorado Rockies sports team, and Kenny has Montfort Companies, and they do a lot of other business, deep Colorado, a lot of real estate development and other investments out of his family office.
And they're from northern Colorado, right?
Greeley.
Right?
Yeah.
Greeley.
Yeah,
so.
Montfort beef was their background.
Okay.
It's pretty exciting. I mean, at the right time, they sold Montfort beef, and that's really why we have a professional baseball team, at least why we got one 30 years ago with the Colorado Rockies, was just the timing then. There weren't that many people in Colorado 30 years ago that could fund a baseball team. So
I didn't realize they were the owners for that long of a period of time.
Yeah.
Oh, wow.
Yeah,
okay.
yeah.
I thought they were, for some reason, I just had in my head that they had bought the team more recently.
Yeah, and funny old Colorado history too. The Coors family, Coors Field, I don't know this is a fact, but it's got to be one of the best naming right deals ever. Because it was, don't quote me on this, but something like $10 million or something, and it was like in perpetuity.
Oh, man.
So, I mean, nowadays it would be like triple that for a year, the Coors family got a really interesting deal there. So.
Wow. Okay, so that Kenny is one of your
so Kenny's one of my partners. Zach May, another deep multi-generational cattle family in Colorado.
And I don't know Zach, and I don't know their family history. The
Mays, as I mentioned, just been around, own a lot of land, a lot of cattle. They have a beef company as well, and they're traders. And just passionate about Colorado, which is why I think Zach and Kenny were both kind of involved in this. And then Paul Foley at the time, Paul was building a platform called Smart Capital. He had a startup of his own and sold that, had an early exit, and was really passionate about investing in early stage companies, similar to myself. And we all knew each other we were, in some deals together. We were really active. I, in particular, had been really, really active. I had invested in 30-something early stage companies, but it was just me. So it started to look a bit like a fund, but it was my personal activity. And I had been thinking for a while, how do I formalize that a bit more? And so it just really worked well to convert, and we just teamed up.
How was it that you became, as an individual, an angel investor in so many different companies? What led to that?
Oh man,
a lot of people would like to do that,
Yeah.
but don't have the background or
Yeah.
the means to do it. Like, how did you end up being able to do that?
A lot of scrappiness. I mean, I did I was pretty well positioned for it because I did a lot of things. And if you want to, go back through some history.
Yeah, please. Yeah.
I grew up. I lived a lot of lives in a decade, pretty quick. But I grew up in Savannah, Georgia. Grandpa was a preacher. I played music. I was a worship leader at church, and so grew up with a passion for music. Was smart, did well in school. I was valedictorian in my class. But I started taking a pretty different path pretty quick. I had a free ride to college, and I was just I knew how to learn. I was kind of done with school. I was just ready to go do.
Yeah.
And so I...
Where did you go to school?
Well, I did in Savannah, Georgia, high school, but I didn't end up going. I had a free ride in college, but I didn't go.
Oh, really? You skipped the whole college thing.
I went
Check you out.
right to work, and built a career pretty quickly in the wireless business. Actually, selling cell phones originally.
Wait, let's go through this again. You're the valedictorian.
Yeah.
You get a free ride, and you decide not to go to college.
Yeah.
That can't happen very often unless you're a tech
I know.
genius.
I know. It was an interesting dynamic. I debated a good bit, but I was just ready to.
How did you have that conversation with your family?
Oh, my I mean, thankfully I have a supportive family, but they probably thought I was a little, little crazy. But I don't know. I mean, it
sounds like we took it in stride.
I thought I was going to be a stockbroker.
Yeah.
I mean, pretty funny story. I ended up working for, the movie Boiler Room?
Yes. Actually, no, I don't know. Boiler Room.
I ended up working for a boiler room, kind of like that, but I didn't realize it. Cold calling.
They don't advertise themselves as boiler rooms.
They don't. You start to catch on to clues, and then when you start to catch on to clues, they're ready to, if you're not on board, they're kind of ready to get rid of you. And so I left, and within days they were gone. They had moved to another, so I guess they lose it.
Kind of pop up and they
they relocate. But I thought I was still going to pursue that, but at the time it was coming into, because I graduated in '99, right? So we were coming into the big bust, and stockbrokers were jumping off of buildings, and it was a bad time to probably go into the business. And so I took a sales job. I was always good at sales. I mean, as a child.
And
I was always selling something.
You said it casually, and I smiled when you said it. But in '99, in 2000, this was tragic. What was happening? When you said stockbrokers jumped,
it was a really rough time. Middle of '99, and I graduate, there was like this brief time where it seemed really, really promising and interesting. They were all making crazy amounts of money and whatever else. And then by the time it was kind of time to really, dig in, things were shifting pretty quick. But
I hear there's a great book about that called Bandwidth. You ever heard of that?
Yeah. From a different perspective. But yeah, absolutely. Bandwidth definitely touches on a lot of what was going on, in that time for sure. But I always had the fallback of sales. I was a good natural sales guy. Growing up in school, I skipped lunch all through, middle school, and I just would deal baseball cards or candy or Debbie cakes or what. I would buy up, everything I could and just wheel and deal and sell at school.
Very cool.
I grew up in a trailer park in Savannah, Georgia, so kind of a reverse. Like I was the only white kid in my neighborhood, kind of thing. And so if I wanted anything, I had to be pretty scrappy to get it. And so I was hustle because I wanted nice guitars, or that's where I spent most of my money early on. So I was always doing something to make money, and And so I went to sales, selling cell phones in a kiosk in a Sam's Club. And very quickly, because I also, had a good, I was smart and I had good business sense. And
How'd that work? Because obviously people walk up a kiosk and they buy their own phone. When you say you were selling phones via kiosk, did you own the kiosk and you would stock it?
No, it was for another company.
Okay.
There was a company at the time that would set these kiosks up in all these Sam's Clubs across the country. And it was back when you would walk in a cell phone store and there would be 8 different cell phone companies in the same store before everything consolidated. So we sold for all these providers and sold satellite TV and satellite radio.
Oh, so by kiosk, I'm thinking it's a machine, but
you're
talking
little,
about like a stand-up,
like a 10 by 10 square.
Okay, so you're actually interacting
sitting
with
in the electronics department section of Sam's Club, and so we were one of those annoying people who would like bother you when you're walking by.
No, not at all. We forgive you.
I was pretty obnoxious at that point in my life, but I was ready to make some money, and but I quickly was store manager and then district manager and then regional manager. And so I ended up taking a really interesting, by like 21, I was managing hundreds of employees. And locations all across multiple states. And it was really interesting because I would go into like different territories for a while. Like they would send me to another territory that was struggling to go like turn it around. And I would go into one of those areas, and it's assumed like you're the son of the owner or something when you're 21 years old, and you're, most of my store managers were in their 40s or 50s, and I was cocky and I was kind of a dick, and
well, if you're hustling in junior high,
I expect everyone to hustle, as hard as I was, and I was willing to do the work, but, I was kind of the guy that would be like, oh, you're not selling. I'll come in, I'll outsell you and ask you why the hell you can't do it. I did, kind of thing. That was my management style at the time. But what was cool is at a young age, because I got to keep going to different territories, I got to keep reinventing myself. So I started reading leadership books and other things. And each time I would get a little more mild in my approach, for sure. And the interesting thing is I got really great results on both sides of the spectrum. I could be like really nice to people and lead by example and get results, or I could be a dick and lead by example and get results. And I was like, oh, but I like myself a little better the other way. And so as that kept playing out, I built a career, and thankfully at a very young age, made good money. After I transitioned out of the wireless business, I ended up going into finance. I always liked numbers and finance, and had a boutique.
And where are you
geographically at this point? I'm in Colorado.
So you found your way to
the
Colorado.
Wireless industry ended up bringing me to Colorado. And I partnered with, there's a firm here in town called Impact Wealth. It's actually based in Boulder. And Jim Teagard and Anthony Harrigan over there were my partners. And I did a lot of we did a lot of alternative investments, a lot of tax strategy work. I was more specifically in the estate planning and insurance side. So I did a lot of large, insurance and the high net worth space. Kind of worked from 20 million to several hundred million net worth space, and built a lot of relationships in that world.
I think in that time frame, Anthony Harrigan was trying to recruit me as a client. I ended up being with Crestone, but I met him through a level 3 executive who he was neighbors with, and I know we had some fun social times together.
Yeah, absolutely. I mean, we were with a lot of.
He should have sent you toward me. You probably would have. You probably would have got me. You would have closed.
But it was, I'm a lifelong learner, so I was learning from a lot of my clients. So what's interesting is I had those entrepreneurial roots, back from the wireless days, and a lot of my clients, they made their money in entrepreneurialism and building business, selling businesses. Did a lot of angel and venture investing, and so it was really a lot of my clients that ended up drifting me into. I'd follow them into deals early on, but like most things, if I get interested in it, I pretty quickly kind of become really go deep. And And so that ended up shifting, and I would do a deal, invest in a company, and bring in a lot of other investors with me, and so now come to that 2019 period. It was time to either slow down on that activity or lean in and formalize it more,
Okay.
and that was kind of what led to partnering with my partners and launching our syndication platform at the time, where we would.
But they had already started, you said, in 2017.
Yeah.
They started
2016. But it was just pitching. There was no asset management. There was no spinning up SPVs. There was none of that yet. And so,
And we said when it was just pitching, they would have
pick a few
startups
companies. They would come and pitch, but people there were left on their own. Like most angel groups, kind of follow up if they had interest. Right.
Gotcha.
Now the challenge with angel investing and angel groups is that, unfortunately, a lot of times not a lot happens, and you end up with extreme adverse selection, right? Because great companies that can go get capital from anywhere are looking for funds that are going to write multi-million-dollar checks, not necessarily angels that are going to give them 25 or 50 grand. And even at a decent angel group, a lot of times maybe they aggregate a few of them and they get 200,000 or something. It's a lot of work. Now there are diamonds in the rough, right? Yep. There are businesses that you can still get in some good deals that way, but your overall selection pool is not the higher tier, right? And that's what we really launched around to try and solve, because I had learned a lot of that the hard way on my own as well. It's like, as I saw more and more deals, you start realizing the difference between like deals I would have done before, versus what I'm seeing now. And it's things you resist as an individual. Like, you don't want to be true, but you're like, oh yeah, there's a reasons why most of the successful venture funds are looking at least several hundred, if not thousands, of deals a year, right? You gotta look at a lot. And so we started with this process where we would lead with our own capital first, spin up an SPV, and then offer it up to the investors in the group. Now we narrowed the noise, right? Instead of all these deals in play or whatever else, it's like, hey, here's a live one. We'll 8 to 12 a year. That we're doing ourselves. You can look at it now. You can make a decision whether you want to be a part of that with us or not.
Yeah, that's the way we do it ourselves. And I haven't wanted to raise a fund. I don't want to be responsible for other people's money in that way. But so when we do a deal, why not? Because I got a lot of miles on me.
Zero headaches that come with having a bunch of LPs.
Yeah. Hey, Dan, can you come see me and tell me how I'm like, no, I'm not going to come see you.
Yep.
But
all the time.
But I do enjoy investing. So we do a similar structure where we do everything through SPVs. We just, if we feel like we want to invest, we invest. But then we have 6 months after we make the investment to allow others to take some of it if they want, and they get an extra few months to see it in practice. And I always tell them, if something doesn't look quite right after we do the deal, I'm not going to let you put money in those. But the ones that look like they're off to a good start, hey, get the benefit of another 3 or 4 months of seeing how it's doing, and then we'll allocate some of it to others if they if they're close to us and they want to do it. So it's not as optimal if you were just managing a fund, but it gives you a lot more flexibility as as someone who doesn't want to manage a fund.
For sure. So we ended up very quickly. We really caught lightning in a bottle for a whole host of reasons. We had a good investor base. It was a good ramp up period there, with a lot of venture activity in 2020 and 2021.
And at this point, you're focused on startups, right?
At this point, it was early. It was seed stage. We were only doing post revenue, but it was early, right? And but our check size, very quickly we were writing 7-figure checks, and that did a few things. One, that pushed us upstream more, where we were more looking at Series A and B, some late seed, but Series A and B stage companies. Two, you start getting access to a lot better deal flow selection, and you're way beyond minimums, and you get treated like a major investor, and you can function a lot more like a fund. But being passionate about startups and supporting early stage companies, and there's a lot of things that we love about and are great about seed and pre-seed stage investing, and we want to support entrepreneurs at that stage. So, but there's this tension around, well, if we're doing this, it's the same work to do a $250,000 or $500,000 SPV as a $5 million SPV. Plus, there's the practical behavior dynamic of most individual investors won't do enough deals, even if they think they will or intend to. There's just all these reasons why they get in the way of them actually getting a bucket of 30 companies over a few years, which seed and pre-seed demands, to have a rational approach to it. So we didn't think giving individual investors access to seed and pre-seed for direct deal by deal was actually we could be a conduit to a lot of bad behavior without meaning to be. So we launched a dedicated seed fund.
How do you mean?
Bad behavior is in just for themselves, as far as doing a handful of deals, not doing enough to get the diversification, the results not panning out very well. Because we really do believe. I mean, you need. Most seed funds are at that stage, they're doing at least 20, 30 companies. A lot of them are doing 50, right? Yeah. And so it's the stage that demands the biggest, total basket over, a few year period. And we didn't want people to kind of accidentally end up only with, 3, 4, or 5 early stage deals. We just think it's better for a fund at that really, really early stage.
Because what we've gravitated toward is early money in. So the last 5 deals we've done have been early money in, but we've gone in with bigger checks. So we go in with conviction. I'm not a big, you hear the expression spray and pray, meaning, find 30 interesting deals and a handful of them maybe hit it big and several of them go, nowhere, and some in the middle. That doesn't feel right to me. I like a mindset where we really have strong conviction about each deal and sort of an expectation that each deal is going to be successful, and just make sure you're getting access to those really interesting, startup deals. Now, time will tell whether we're missing something, but it feels like the right thing to do for us.
Yeah, but you're doing a lot of deals, though. I mean, how many do you have in the portfolio? About how many a year are you doing on average?
Well, new deals probably 3 or 4.
3 or 4 a year.
3 or 4 brand new deals, and then probably follow-ons is probably at least that number. Although this year has probably been a little bit higher because
that's
yeah. In fact,
I feel like I know of more than that. Yeah.
Yeah, but most of the ones you know about aren't. How many of them are new, right?
Oh, fair.
Yeah, so,
follow-ons, right.
Yeah. So 4 are. We're about ready to do hopefully a 5th new one that fits the same profile. It's certainly a very early money in, first check in, but going in with conviction.
Yep.
And think really highly of the opportunity.
Yeah. And so I think that you're still diversifying a lot, even though it may not be as extreme. It may not be like a spray and pray type dynamic where it's like, well, we're going to do 30 deals a year, right? But you add up that 4 or 5.
Oh yeah, we've done
per year over
25 deals.
5 years. You've got 25. I mean, it looks like a real diversified fund, right?
Oh yeah.
And so that's our point. That one of the things that we found over and over and over again, even though you tell people that they should do, at least a few deals a year, and then there's time diversification, right? You just keep steady deploying. It's very important because, every time you look at the venture returns map, it's like in every decade,
Vintage
there's
matters.
2 or 3 vintage years that really just crush it. And the other years, venture wasn't worth it as a asset class, right? But those 2 or 3 is like what really drives and if you think you can predict that, good luck, right? It's the similar to public markets, right? If you miss those big up years, you miss, the majority of the returns. And so,
actually, I think you can predict that with the benefit of some kind of hindsight, because the best vintage years are correlated to the lowest amount of venture raised in those years. So years where there's a lot of venture dollars raised tend to be the worst years, and those years where the amount of venture raised is low tend to be the best years. In
Yeah.
fact, I think the pattern is like so compelling when you look at over a 20 or 30 year period of time.
Yeah.
And it feels like we're in one of those best periods of time right now versus 2021, 2022. It was the polar opposite. It was kind of like but the deals right now just seem to be really compelling.
I agree. You can in like larger swap, over like a few year period, maybe even a couple year period, I think you can have a pretty good sense that it's probably one of those better periods. In any given kind of shorter period of time, like while you're deploying and writing a particular check, right? It's a lot harder because
it's hard to sit out when it's
you don't know where exactly you're at in a cycle. So yes, we knew in this back half of 2022, for example, that venture capital deployment had just taken a massive nosedive, right? But then how long is the period to kind of clean out a lot of the bad, right? Where the companies that really don't deserve capital fail, and the ones that do, continue to thrive, and that could take a while. And so
that's still
does that
playing
mean
out.
that 2023 ends up being a killer vintage year, or is it more 2024 and 2025? Like that's the stuff where I think time will tell, but overall, I think that period is pretty good.
My prediction is 2025 is going to be an excellent vintage year. That may change by 2026, might already be changing, frankly, with the amount that's flowing into AI. But I think this window of maybe late 2024 through to maybe now, I think that 12-month period of time is going to be uniquely interesting because we're coming out of that really tough cycle, and everyone is really hesitant to write checks in 2023, 2024. So maybe that would have been a good time, but people weren't investing. They weren't really. They were being very careful. I think we started to come out of that late last year and came out of it big this year. But at the same time, it feels like we're starting to get into a cycle where, depending on where you're investing, especially if it's AI related, you might be on the other side of that and starting to look like 2021 all over again.
Yeah. I agree. And the cream rises to the top, right? And you get through that period, and the companies are able to make it through a tough, environment to raise capital, either because they were able to continue to succeed without capital, or because they really stood out to get the little bit of capital that was available. They start to stand out, right? And
boy, I tell you, this is when you also see, and I know you believe this as well, how important it is to back the right people. Because when the going gets tough, the tough get going. I mean, that applies to, when startups hit those cycles where now they're in a really tough market. It's hard to raise capital. The customers are showing a lot of uncertainty. That's when businesses are most prone to kind of fall apart. And the leaders who don't have the resolve, they don't have the tenacity, they don't have the creativity, they can't pivot. They're the ones who get just caught in those cyclones. But you see the other ones. One that we're in together is going to, I think, be an all-time case study for this. The ability to fight your way through the most dire of circumstance and somehow emerge on the other side of it with a huge opportunity. You see that, but that's 1 in 20. But boy, do you start to appreciate those executive teams.
Yeah, no, 100%. And I'd love to talk more about leadership for sure as far as startups. And I think just to put a pin on the kind of the diversification topic.
I'll talk more about leadership right now.
To clarify, well, I just going to clarify one thing real quick. When I said kind of the bad behavior, what I would see happen over and over again is investors would come in, they were liquid at some point.
Yeah,
they'd go deploy in 2, 3, 4, 5 deals, and then they would be less liquid, or they would get more busy, or your failures often happen faster than your big wins, right? Because your big wins are on paper for a long, long time, and your failures are like you're watching it happen. Like, oh, maybe I don't know what I'm doing. It's like, this is a 10-year cycle, and you got 12, 18 months and a few deals into a long cycle, and you're going to sit back and wait for the next 10 years and see if you're strategy work? That's not a strategy.
Yeah.
And so
That's a great
that
point,
is
yeah.
exactly what we were like, okay, well, recognizing humans are going to be humans. All
Yes.
these things happen. How do we, as much as possible, set them up to succeed? And we figured the later stage, if we were giving them more of the later stage opportunities, which are actually harder for individual investors to get access to, and then as things happen, it's more likely that that works out okay for them than at that really easy or really early, seed and pre-seed stage. That's why we kind of set up moving our deal by deal SPVs to later stage and using a fund for people who want the really early stage
sense.
exposure. So,
Yep.
but a big part of our thesis across the organization, so we launched Denver Ventures because, yes, we have an investor membership group that with 850 investor members, but we're also professional asset managers. We embrace that, and at a certain point, when you have hundreds of people investing with you and lots of family offices, they're looking to you. And we wanted to build out that professional infrastructure around it. So we launched a dedicated seed fund to do the really early, and we continue to do the SPVs. So those are kind of the three verticals for the organization: our member community, our SPVs, and our seed fund. And our primary thesis there is around what we call founder DNA, which is exactly what you talked about. And I think this last cycle in venture is what really highlighted very much, because when venture capital is really hard to get for companies through 2022, 2023, 2024, it's beginning to free up. If it's AI, it's very broadly available. If it's other categories, it's still less than it was kind of pre-pullback in 2022, but enough, right? And you see these huge differences in how the founders handle when it gets tough and when money isn't easy, and which ones can really tighten the belt, figure out how to get by, which ones can figure out how to raise the money when they have to, that can make the tough decisions, that make the tough decisions fast enough when they have enough runway versus, at the very end. And I think the biggest one that really stood out a lot is the agency. Which ones, when things aren't going well, can really take responsibility for it or just point the fingers? Because it's really, really easy when the overall venture environment is bad and it's hard to raise and it's very easy to just start pointing the fingers at all these, macro dynamic reasons why you're failing. But those might be valid, but at the same time you go, well, yeah, but then I can also point to other companies in your same sector, similar business model, whatever else, that are thriving. Why is that, right? And I think the agency is, oftentimes a big part of that. It's not the only. But it really got us thinking and going back. And so I went back through a lot of my old deals that were, angel investments I made, pre-Denver Ventures, and my partners and other people I know. We really went back through a lot of our old deals and thought back around a lot of the ones that didn't work out and why, and kind of writing out why, post-mortem, in a lot of those. And the interesting thing is, were there some companies that, maybe we missed the market size, or maybe the product wasn't as compelling as, we thought it was, or a different thing? Absolutely. I mean, there was some of that. But honestly, the biggest thing was the founder, where there was definitely some clear points where, they lacked the resiliency and they gave up when it got really hard, or, they just really,
Or
didn't
froze.
have the agency, and, or they froze, or they just made really bad decisions because stress can lead to that, right? It can lead to making, really bad decisions. And so we kept going more and more. Well, everyone knows it's about the people. No one's going to really argue with you about that, with early stage investing. But yet, as investors in venture, you end up spending most of your time on the business and the market and a lot of those things. And because it's easier to quantify, right? Like, you can measure it. It's a lot harder to measure the human capital side of things. So we spent a lot of effort on how do we go about in a reasonable way that didn't feel like a science project on human evaluation or anything, but like how do we really lean into how we think about founders and the leadership team, and do they have a lot of the traits and characteristics that are going to be really important for them to be successful, and how self-aware are they of their strengths and weaknesses and blind spots and those things.
Well, this is an interesting discussion. So my favorite all-time professor who's been on this podcast, Steve Kaplan at University of Chicago, was also on my board at Zayo. He and a couple other professors did a study, and they had excellent data. So they had data. They had two forms of data that they were able to correlate together. One was data that had to do with personality assessment, management personality assessment, that was done before the person took on a C-level job.
Mm-hmm.
Okay, so you have professional data provided by a professional agency that scored you, scored Gibb, scored Kendall, and then they were able to compare that data with those who went on to be a CEO and CFO and find out how they did as a CEO, CFO. So they've got these two massive data sets where they're able to see the outcome and they're able to see what the management traits were. So the question is, what management traits correlate with best outcomes? So what do you think came out of their study?
Yeah.
What management traits do you think were correlated with great outcome and which weren't?
Yeah, on the management trait side, because we look at it a little different, because we're dealing with a very bizarrely unique set of humans, right? That can like scale a
but that's what they were looking at. That's what they were looking at too.
That
they were looking at people who became CEOs, were venture backed or private equity backed.
Okay, got it.
So that's what they were looking at. They're like, what VC backed private equity? Because they were looking at data. The data set they were looking at was Carta or something like that, so they could see who took on those roles, who was hired to be a CEO, tech CEO, or another C-level such as CFO. So they focused on those people and what kind of success, meaning financial outcome. By success, it wasn't did they turn out to be a nice person, and did they do this? It wasn't that. It was like did they lose money for their investors? Did they just make the money back? Did they have a home run? So what were the financial outcomes of the people who were backed? And we have data on them before they were backed as to what their personality traits were.
Yep. A lot of the big ones that we've seen, and we've also gone to a lot of people who've had big successful outcomes and asked them, help us better understand more people like you, and have them, kind of go through our process as well to kind of compare to, people who are going through. But a lot of the, a lot of them are common traits, and what matters is kind of how it.
Well, tell me what they are, and I'll tell you if the study.
The consistent themes are very high self-confidence, very low self-critical, very high proactivity, so like biased action, very very high agency.
What do you mean by that?
Agency, like self-responsibility, taking ownership of things, not just doing it, but really taking ownership of it. And there's a lot, like 22 different, kind of behavioral traits, but those are probably the most consistent ones that are just like high like dominance, like strong. Those are probably 5 of the ones that are just like super ultra consistent. And then past that, a lot of them are pretty consistent, but a little more variable, right? But those are kind of like every single, like 99% of all, outcomes of, successful entrepreneurs at least exhibit those.
Yeah, no, and I think that's very, very good. That correlates with the outcome of the study. And therefore you'd say, well, isn't it obvious? But most people don't say what you said. Most people are like, if you ask people, what do you think makes a great CEO? they'll say things, well, they're great listeners, and they really bring people along with them, and they're really strong communicators, and they're just really charismatic. And you're like, no, none of those are
Yeah.
where the most correlation exists. In fact, when you think about it from the lens of who are the great CEOs that we think of our time, most of them had serious flaws, right?
Oh yeah, 100%.
Yeah, these are
Yeah,
not
yeah,
your
yeah.
poster child, great people,
Yeah.
talk like Gavin Newsom with the nice hair and saying all the right things. They're people who have, they're intense.
Yeah.
A lot of the words you said, the words they used were a little different, but we're getting at the same thing. Extremely decisive.
Yeah.
Extremely action oriented. They described one as just extremely intelligent. They just know a lot of things about a lot of things, but they're willing to pivot. They'll be like, we're going to go and get that mountain there, and I'm going to go get it. I hope you guys follow me. If you don't let the door kick you in the ass, but that's where I'm going. And you start climbing up the mountain, and all of a sudden you see your leader, take a right turn and start going up a different mountain, and not even explain to you, not even say, hey, I'm sorry, I apologize, I thought it was that mountain, but it's really this. He's like, I don't know why you guys thought it was that mountain. It's this mountain we got to go up. So let's go. So easy for them to pivot. Don't get caught up in feeling like they did something wrong because what they thought yesterday is different than what they thought today, and it's all about we are going to get to that outcome. So they tend to be in many ways flawed people too, because they could be over aggressive. They could be not necessarily be nice to the people around them all the time. They're not necessarily great communicators. They a lot of times like, well, you're gonna have to figure out why I'm doing this on your own. I don't have time to explain it to you, but if you want to be with me, you're gonna have to do this. You have to do that. So they tend to be Steve Jobs or think of really anyone in life there, Elon Musk or Jeff Bezos or
Gates.
they all almost everyone you can mention. Now, if it's a CEO they brought in later, if it's the company's,
they might be a little more seasoned and well-rounded and more like what most people describe. It is. It's a really interesting dynamic because what you were saying, most people describe. I think most people describe the person that they would like to work for.
Yes.
Right.
Exactly.
Not necessarily the person that can will a multi-billion-dollar enterprise into existence, at least in a short period of time, because you got to think, right, fund returners, so 10-year periods. And it's interesting, there's a lot of big, great, very successful multi-billion-dollar, multi-generational enterprises that, I think have really just great humans, great culture, people love working for them, and a lot of those things, and they built it gradually over a long amount of time. If you're trying to go from zero to billions in under 10 years, that requires a very unusual person, right? And so I think that's where what we look at a lot of. I mean, one, there is a certain level that it's like, well, who do you want to be in business with and married to? And if they're spiky people that are really extreme in certain characteristics can ride that strength and ride it all the way to huge success. They also can ride it right off a cliff. So there's got to be, but you're not looking for the most well-rounded people necessarily, right?
Well, it turns out most well-rounded aren't. If they're very well-rounded, they probably took a corporate path or a consultant or a banker or work for a big company. It's ones who feel like they got something to prove to themselves or to something.
So it ends up being in so much nuance in how do the traits interact with each other, right? Because if they exhibit a trait or don't exhibit a trait, in and of itself, most of them, other than kind of those core ones, that could be okay.
Yeah.
As long as they exhibit something else that kind of counterbalances it, right? And so
it doesn't mean that they're bad, have the bad behavior. The bad behavior is, because we back a lot of CEOs who you kind of get a sense that they have that resolve, that tenacity, that intelligence, that we will not fail, that we'll be able to figure it out.
Yeah.
And that doesn't mean that they have all these other bad traits. sometimes they do, sometimes they don't. But it often means they're not just, kind of that, idealistic, CEO type that communicates really well
Yeah.
and tells a great story and, does everything kind of the right way. They're often, quirky people, not quirky bad, but quirky in a way that, they're super focused. They're, hyper committed to what they're doing. They're myopic in what they're trying to accomplish. They're, again, off the charts smart usually. And what we've been reminded of, or what I've been reminded of is, we all, like you said earlier, every investor says that, yeah, we back really strong people, but but really understanding what you mean by that, and are you really doing that?
Yeah.
Are you really zeroing in on people that you're really gonna, when the going gets tough, are gonna have that resolve? They're really gonna create something, and they're really gonna work their ass off, to get through whatever obstacles they need to get through, and they're gonna find people who will join them and do it with them. That becomes so important.
Yeah, it's huge. And what it ends up resulting in is a lot of gut feel, and a lot of people really, oh yeah, it's all about the people. So they're backing people that they like, people that they get along with, right?
Mm-hmm.
And I'm not suggesting backing people that you dislike and don't get along with, but a lot of times
You put too much weight in that.
Yeah, they're not necessarily going to be your best friend, but you're like, holy cow, this guy's got something, right? The finding a way to quantify that and measure it and know what you're trying to evaluate and look at. And there's no cookie cutter, it's
No.
not, you can't score, human traits really. But if you're thinking about it, it leads to asking the right questions to understand them more, and which I think leads to a better investor, founder relationship early on when you go in. If you feel like, if you've asked them a lot of the tough things and tried to figure out how well they understand themselves and what blind spots are, and having some of those tough conversations, and I think awareness is huge. And so what we
And what do you mean by awareness?
Yeah, so like self-awareness for the founder. So I think self-awareness is the meta trait. Like we look at it as sort of like core, inherent traits that people possess, and then there's adaptive traits. Like there's areas where people maybe isn't naturally strong for them, but they can do really well in it because they're very adaptive. And then there's awareness.
Well, let's talk about that a little more, because when you say that, that doesn't jump out at me right away. Like a lot of the people I think of who have been very successful, I wouldn't put self-awareness as one of their traits. In fact, sometimes there's a lack of self-awareness that you're like, well, I hope they figure that out. But they're also kind of people you don't want to be, a lot of them aren't very coachable. They're more stubborn than coachable. And sometimes, the best ones do understand, and maybe this is where you're getting at, that they understand where they're, I guess I'm saying the same thing. They begin to understand where their strengths really are.
Exactly.
And who they need around them to compensate for where they might be weak. And
many of them may not seem on the outside like they're self-aware, because a lot of people would be like, well, if they were self-aware, they would stop being such a dick, right? Or if they were self-aware, they would stop driving so hard, but that isn't necessarily self-awareness. That's adapting yourself to something that you think should be. So you think of like a Steve Jobs.
Yeah.
I think he was very aware he was difficult to work for. I don't think that was like surprising to him, right? I would imagine he and his team had those conversations with anyone, coming in, and so you can be self-aware, but you can also recognize that, well, to change the world in this way that I'm dead set on doing it, I have to, I can't pull this back too much, right?
Yeah. If you want people to respond, sometimes the shortcut is just to be direct, to be like, hey, I could take 20 minutes and be really nice and sort of explain it to you, or I could be like, say something in 30 seconds, and you'll probably, you'll learn what you need to learn, and you'll remember it a lot more crisply. you might think a little bit more negatively of me, but you'll get over it. And,
Yeah.
But I don't have 20 minutes all the time to kind
Yeah.
of coach you and, stroke your ego and kind of explain really softly about what it's like, hey, did you really do that? If not, you got to figure out why you didn't really do that, because, that hurts us. We got to move on.
And so the reason I call self-awareness the meta trait is because if you're aware, you can manage to it. You can hire accordingly, and you best understand your unique characteristics that make you the only one that can do what you're doing, and lean into that. And then you can understand the areas that you're just not gonna excel at, and you can hire accordingly. And
Yeah, I agree with what you're saying, but a lot of like the entrepreneurs that we back, they don't have that. Maybe they do over time, maybe they grow into that. But a lot of times when we're backing them, they're at a state that's because I have people flashing in front of me who we currently back, and conversation we had like, man, I sure wish they could take a half step back and realize these are areas that are important and need to be done well. It's not their sweet spot, and that's okay. Their the reason we love them is because of these things, but they seem to be unaware that, you really do have these blind spots, and you've got to build, team around you if you're going to want to scale up and get to that next level. And it takes some of them a while to, so that's the other thing I think around, a lot of the best leaders is they also have to learn things the hard way.
Oftentimes, yeah. So there's another one is trajectory, right? So their personal growth trajectory.
Yeah.
So they may not be fully self-aware of everything early on, right?
Yeah.
But are they a high slope individual that
Yes.
is learning quickly, adapting quickly, growing quickly as an individual?
And they want to get way up
there. Do they
there.
exhibit, enough self-awareness that you're confident that they will figure it out, right? So it's not like they're perfectly self-aware of everything. Oftentimes they're not. They haven't done it yet, so there's only so self-aware of how you're going to be in a certain situation. But you can measure their self-awareness of their current situation, right?
Like, will they figure it out before what they're doing implodes?
Yeah.
It's like, I hope they figure that out before it explodes on them.
And everything for startups, everything's stacked again. There's 100 reasons why the dang thing can implode, right? So you're very much taking bets on, it could be the greatest. We've all seen so many times the best technology, the best product, the best brand, the best whatever, not end up making it. Mm-hmm. And you go, but that was the best tasting blah, 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 or that was like the coolest user experience, or that was the, this technology should be the winner. And there's just so many reasons that it can fail. And so you're very much taking a bet that this is a person that can, just shock absorb all of these things along the way and just keep, adapt, learn, and just keep pressing through it.
Yep. And I think deep domain expertise, that's what we also remind ourselves of is, someone who, it's not hard to have good ideas, I don't think, because most good ideas are probably pretty obvious, but the problem with good ideas that are pretty obvious is a lot of people have those ideas, so you got to realize, okay, if it doesn't sound like it was, that the idea is that novel, it's probably because, lots of people have figured that out and are pursuing it and trying to make the business work, and, some subset of them are going to be successful. But when you start to find something that's really deep and unique domain expertise, and then is matching that up with an idea, then it's much less likely that others are going to have the depth and breadth of kind of the understanding of the opportunity and the ability to move quickly. So we often, why do these people, why have they figured out something, this founder or this founding team, have they likely figured out something that is unique from what others are doing? And, you often find like, they've got kind of a domain expertise, what they've done over the last 5, 6, 7 years is such that what they're seeing, most people could never see, because they, very few people are in that kind of world that they're in.
Yeah. Domain expertise, it's interesting. It's a double-edged sword, because on one hand, it's very comforting. Like, they know the domain, and it could be a competitive advantage. And then here, what's really fascinating is that go down the line of all the biggest outcomes of businesses, and they had no domain expertise. They were able to first principle everything without the baggage of how it's always been done and the boundaries of what they were taught in the science or technology or just or just societal norms or fill in the blank. And so it's a fascinating thing, and I wrestle with this a lot because go down Mark Zuckerberg, Bill Gates, Steve Jobs, Elon Musk. I mean, we could keep going. No domain expertise going into their initial big, what they did initially.
No, I'm not so sure I'd agree with that. I mean, because domain expertise could be that they're really deep in an area, not that they spent the last 5 years kind of having a certain career track at a big company, but when you talk to them, they could really demonstrate a deep understanding of what they're talking about. Whereas there's other ideas where people are like, this is a really clever idea, and it's kind of
okay, so I guess it depends on how you evaluate, because a lot of people, when they say domain expertise, they're looking like, did they work in that industry for 5 or 10 years and know it intimately, right? What you're describing is, I think more, can they get into the weeds and just really become an expert in something quickly?
Yeah.
Where
do they have a unique
unique understanding and knowledge?
Yeah.
Yeah, absolutely, yeah. And that I agree with, right? Like, and that's that trajectory thing where a lot of times these really big, these really successful entrepreneurs, it's just unbelievable how fast they can be a sponge and become an expert in something really, really fast. And even when you think about the deep domain expertise, like worked in an industry a long time, whatever else, a lot of people like to back that, right? Because I think there's some safety to that. But outcomes say that it actually is less likely to lead to your anomaly outcome.
Yeah.
It's probably safer investments as far as like most likely to lead to a good outcome. But it's actually less likely to lead to like this crazy outlier.
Yeah,
outcome.
no, I definitely agree with that. I mean, that I agree with. If it's just, if people are just coming up with a tweak to what they have already done, or their industry's already doing, that's not going to be explosive.
Yeah.
So it's probably matching things together that weren't necessarily one and the same before. Like I know how, I don't know what Jeff Bezos is doing when he decided to sell books, but it was if all he was someone who was in the book industry and didn't know anything about this emerging world of, oh my gosh, you got this internet thing, what can we do with the internet to move, merchandise? It's kind of the combination of those two things that the light bulb goes off, I would imagine. So you guys, the fund aspect of what you're doing, you really just established that recently, right?
Yeah. The seed fund had its final close at the end of 2024, and it's deployed about a third of the fund at this point.
And the size of that, and so that's the true early stage.
Yep.
Seed,
that's a $20 million seed fund. It'll make 25 to 30 investments over 4 years, and making $500,000 to $800,000 checks at that, all the way to, kind of the idea stage to, hundreds of thousands of revenue, kind of pre-seed to seed. So.
Mm-hmm. And that one you're less heavily involved with. Is that the right way to think about it?
Personally, yeah. So I'm a partner. I'm the fourth partner in that seed fund, but I have 3 partners that are full-time dedicated, like they're only dedicated just to the seed fund. Yeah. And then I'm broad organization-wide, and then on our growth stage side, we have a small internal growth fund. With me and my partners, we lead any of those deals, and then add on from our investor base. And that we're doing $1 million to $4 million investments, more like Series A and B stage companies. And we're deploying probably about $20 million a year across both sides. About 70 million total of deployed so far.
Okay, so let me just make sure I'm understanding this. So it sounds like somewhat of a similar model to us. So you described it as a fund, so it's a handful of you who will do the initial deals on the growth stage opportunities, and then you'll do it through an SPV structure, and then you'll bring your network into that to augment what you guys are otherwise investing.
Yeah, our fund basically leads that SPV,
Mm-hmm.
invests in that SPV, and then the rest of the investors of our investor base comes in on a deal by deal basis and participates in that SPV. We write one check. Yeah.
Gotcha. Yeah, makes sense. So, what are you excited? And geographic scope, how much of your focus is Colorado versus branching outside of Colorado?
Yeah. That early on we were 100% Colorado. Now we're Colorado heavy. I mean, across the organization, it's still probably 70% of the portfolio. And so we'll be Colorado primary, but we have been branching out and investing across the country. And that's just a matter, you talk about LPs, it's like, well, once you're bringing on other people's money, while we believe Colorado is a fantastic ecosystem to be investing in, and we have a unique advantage to see great deals and support companies here really well in Colorado, and we want to lean into that to be able to always do best by our investors. We want to be able to have access to all of the best, and it's that Colorado often wins a large portion of that. Not that we're beholden to that. So.
Well, we're increasingly beholden to Colorado.
Yeah.
We'll make.
Well, you've really put you're all in on which I love, because that's been a big part of my passion, for a long, long time. And what's interesting for us is even as we begin to invest across the country, Colorado heavy, 700 of our 850 investor members are here in Colorado, and hundreds of those own businesses here in Colorado. So the way we've gone about our where our capital sources are and deal flow and everything, and they're a big source for a lot of our deal flow and helping us diligence deals and supporting companies. So we're just we're deep and long Colorado, no matter how you look at it, and want to see the ecosystem succeed. And you're going in huge on Colorado. So.
Yeah, we are, and it's certainly I want Colorado to succeed, but when it comes to investing, there's 100% of the reason we invest is because we expect a really good outcome. There's no noise. The reason we care and focus on Colorado is maybe threefold. One is I think there is a lot of great opportunities out here. And if there aren't, just don't invest. It's not like we have fun and have to invest. So I don't feel like we're anywhere close to not having really good opportunities to invest in. So that's number one.
Especially at 4 or 5 a year. I think you can deploy there's a robust enough ecosystem here. You can do 4 or 5 great deals a year in Colorado, 100%.
Yeah. So that's kind of fact number one. Fact number two is I think the best deals, in the last 5 deals we have all fit in this category. The best deals find us quickly. So we invest a lot in platform, a lot in kind of building relationships within the ecosystem. Because if you have to go chase down the deals, like if you have to find them, you're probably going to be late to the party, and you're probably going to be finding deals that have been having difficult getting funding, which means they're probably not the best deals. But if you create a platform, and you guys are doing this as well, where the really good deals come your direction early on, you have more of an opportunity to invest in really good deals. They're finding you. You're not looking for the needle in haystack. The really good deals are like, who should we get backing from in Colorado? If they know to come to you, first or second, that's a huge advantage. And the last thing is, I think we'd be more helpful to companies if they're in and around us here, especially because I'm not going to hop in, and I'm not going to hop in an airplane and go visit companies very often at all. So if I'm going to go visit them and spend FaceTime with them, they kind of got to be here because of my lifestyle. I'm not going to go visit them somewhere else. But I think we can be helpful as a team for those who need and want help on they encounter something that's new to them, or they need an extra resource to help them in a particularly busy area. We want to be available to help them and stay close enough, have a close enough relationship, build enough trust so they want to tap into that help. So I think that's the ability to do that if they're local is much higher than if they're in California. But the opportunity to find really good deals outside of Colorado for us, I think it's much less likely we're going to find the best deals if we stray geographically away from here. Here we'll see the best deals that exist in Colorado, I think, or most of the best deals, and be able, to be invited onto their cap tables. So that's kind of our philosophy, at least.
Yep, it totally makes sense. And we've worked hard to build the network outside of Colorado as well. To access more and more of the deals there. So part of it's just like intentionality, right? But Colorado, I mean, and we're similar in that we're different than most of the Colorado capital in what we can invest in. And so this is, one of the things I think is a big opportunity for both of us is the flexibility. Most of the Colorado venture funds, hey, if you're a B2B SaaS or AI company, you're going to have options and they're going to be, falling all over themselves and competing to try and get in. And then once you get out of that, there's not as many places to go as far as funds. And so we've, feel like we really have been able to have a heyday in those other areas. I mean, we have plenty of AI, in the portfolio, but which honestly is where Colorado, I think, has a unique advantage in a lot of ways as well. We are a really great leader in a lot of these, other, more tangible hard tech and, other kind of, opportunities.
Yeah, no, it's
and it's funny that so much of the Colorado capital won't invest in those.
Yeah, although they're starting to realize it, because I think historically Colorado capital has been not entirely, but somewhat an outgrowth of the Foundry Group and TechStars. So the formula was software, B2B, maybe B2C, but it was all about spray and pray type of mentality from 10 years ago. Small checks in a lot of companies and double down with ones going well, but stay focused on software. And that was a good formula if it was 10, 15 years ago. And a lot of the funds that got started here kind of had a TechStars background or the new Foundry Group, so they kind of took that approach. That's what Silicon Valley was doing a lot of 10 years ago. But what's evolving very quickly is a very different opportunity set to invest in. Even with AI, which you can think of as software, AI is just software is a lot less interesting than how AI is interacting with the real world. So the intersection of the physical world and AI. So some people refer to physics AI, other people refer to the defense tech category, or the reindustrialization of whatever your given country is. In our case, the U.S. So how AI is affecting manufacturing, how it's affecting space, how it's affecting what you need to make AI work. Digital infrastructure, AI infrastructure. So there's all kinds of examples of needing to be willing to invest in businesses that have a hard tech component to it, which I'd love doing that. There's a perception that's much more capital intensive, but I'm not so sure that's true, because you see a lot of these pure AI plays and they're raising hundreds of millions of dollars to try to get something to work, versus a lot of the hard tech. You look at how much really got invested, in aggregate, 20 million, 30 million, 40 million, and the companies are taking off. There's ways of using kind of non-dilutive sources of capital or customer, related capital, and they end up getting, building significant businesses in a pretty capital efficient manner.
I agree. It's definitely a misconception, and I think the data supports that I've looked at. But it's rooted in some truth, right? It does require more capital early on to function. A lot of these other models, they may pile a lot of capital behind it to grow, but it isn't as much capital that's required to just survive, right? I mean, these manufacturing and hard tech.
Yeah, it's true.
It's like it just takes more capital for a while until you get it to a certain level of scale to survive. And their competitors these other areas at early stages might be raising a ton of money as well, but they're doing it to, really put the fire, to really scale up fast. But to your point, there's a flipping point. There's more non-dilutive funding. There's real assets. There's more debt options earlier on. And it ultimately, as far as, the long scale, it does not have to be more capital intensive by any means. And it's a stronger moat. And especially, one of the things that is interesting to me with all, everything going on in AI and everyone, pick a category, there's 18 companies all working on the same thing.
That's why I'm on the domain expertise.
And it's so fast, right? It's like your technology can be, someone else can one-up you, the next day, week, month. So we're shifting. It didn't used to be that way in technology, right? It wasn't so fast somebody couldn't catch you tomorrow in your software, your B2B, SaaS platform. It would take time, right? Now it's if you could vibe code something that's better than, and it's crazy. So what are your moats? Well, hard tech, you can't stand that up tomorrow, right? No matter how technologically savvy, someone could be better, could be faster, could be a whole lot of things. If you already got to a certain point, it will take more time for them to catch you, right? So there is a little more of a moat dynamic that I think is interesting. And I think that we have, we all just know, we have the most catching up to do on that side. Our technology, our capability overhang is just, we could stop advancing AI and a lot of our technology, and it would take us 10 years to catch up on the hard, on the infrastructure and robotics and whatever side to just maximize what AI is already capable of doing. And so we have there's just so much need there to catch up.
What industry sectors, and maybe focus a little bit more on Colorado, what areas do you think are most interesting, that are catching your attention the most, that you're most focused on? So what sectors within the investment universe do you care most about right now?
We are pretty much sector agnostic, and we're extremely diverse if you look at our portfolio. This is where for us, it's like we're really heavy on this founder DNA, and then it's like we're really looking for, we need to believe it's a big enough market, and we dive into the business, and we have a lot of diverse talent amongst the team to be able to, to diligence a lot of different, business sectors. And then with a big investor base, like 850 investors, that all business owners have a lot of expertise, we can really tap into that to give us a right to do things that may be out of our primary domain. But our central thesis is on that unique individual side of things, right? Is this the person? We believe their thesis. It's a big enough market, and we buy into their being able to either they have a moat or there's a path to developing a moat, right? And that person, right? That's a person that we're really going to bet on, and so we're pretty excited about most technologies.
What do you think Colorado's particularly good at? Like, what do you think our strong sectors are?
Yeah, we certainly, on the early side, we obviously are early leaders in quantum and space, and a lot of space is more mature than quantum out here, but we're obviously big leaders there. We do great in a lot of the material sciences and a lot of advanced manufacturing. It's kind of funny. A lot of people don't think of Colorado with manufacturing because it's not generally a very manufacturing friendly place. But when you start getting into more advanced manufacturing side of things, we have a really strong ecosystem. We've done a lot of investing there. Clean tech. A lot of bio. We're a lot of biosciences, which I find fascinating, and it's probably the one area that we just have struggled to figure out how to lean into. I think it requires.
There are some fascinating companies
there's
out
some
here.
really
There's
fascinating.
some great
yeah,
things. Yeah,
absolutely.
we haven't invested in that sector, but we're gotten to know some of the companies. Like, man, they're doing some big things.
Yeah, I mean, I'm just excited about this convergence. I don't know. Have you ever looked at like the historical chart around like these GDP pops whenever there's any kind of like multiple technologies converging, right?
Yeah.
And usually it's like these two or three,
Hmm.
are converging, and we end up with these like just
It is a
massive
step
productivity lifts, right? And then we kind of dip, and there might be like one-off things, but it's when two or three technologies really converge that we end up with these huge lifts. We're in a wild time in history. I mean, the next decade, we've got 5 or 6 major technologies that really are all going to be converging
Yeah,
at
no.
the same time. And AI being obvious when everyone talks about, but robotics and autonomy and self-driving and energy storage and bio. I mean, just bioengineering, and it's like it really each and every one of these areas in and of themselves are massive catalysts, and as it all starts to converge at once, I mean, we're in for a really wild, I'm sure bumpy and messy and whatever else, but I can't think of a more exciting time to be an investor. And obviously, in the short term, we could have blips, but over the next decade, man, I'm all in. Like,
Yeah, no, I think we are in that mode right now. I mean, it's one thing to say it's coming. Like if it was like 3 years ago, you might have been like, wow, something feels like it's about to happen. This thing called AI is starting to pick up momentum, and people are talking about quantum, and robotics is starting to look different, and advanced manufacturing and blockchain. But it would have been 3 years ago, you'd been talking about something feels like it might hit. Now it feels like it's hitting. I mean, it's happening.
Oh yeah.
I mean, the rate of change right now, the rate of of just fundamentally unpredictable outcomes. I I'd have to go back 2 or 3 decades, and even if I did, it wasn't happening as quick and as dynamic as it's happening right now. This is a probably unique in the history of humankind, kind of intense periods of change.
100%. Yeah. And I have to say, complete rabbit trail here, but I'm really impressed. I can tell you do these long form podcasts a lot because you haven't gone for your water once that I've seen.
Really? Well, that's because you're not paying attention.
I'm not paying attention then.
That puppy is empty.
You guzzled, right? So clearly when I get talking, I don't pay attention. But.
Yeah, there you go. You were doing a lot of this.
I'm an animated talker.
Yep. So what else? Let's talk a little bit about your other passion, music. I didn't know that about you until recently, and then you touched on a little bit at the beginning, but I'm told that music is a big passion of yours.
Yeah, definitely. It's one of the many areas of my life that I realized I was good, but not great, right? Mm-hmm. Like I'm one of those people that I'm good at a lot of things. I'm even great at a lot of things. I'm not exceptional at like that one thing, right? Which is I think part of what's led to my passion for supporting these entrepreneurs in this journey is because I think for the longest time I like tried to make myself be that exceptional individual in like one particular area instead of just embracing the fact that it's like, no, I'm like a really great generalist that's good at a lot of things, and how do I most maximize that? So music was one of those journeys for me where I really went. I grew up playing in music and singing and writing music, and after I had a successful career and had made enough money that I could spend some money on it. I built a recording studio, and I was and had some writing buddies, and we would do a lot of writing together, and went to a lot of songwriting conventions, and we wrote a song that actually almost got picked up by like a song pitcher. Took to Rascal Flatts, and they liked it, and you're like sitting on the edge of your seat, like they might record or whatever else, and time goes by, and then you find out they didn't, but or at least didn't make the album. And it was just kind of a light bulb moment for me because one, I was around all these extraordinary musicians and singers, and you realize just how much luck there is in the industry as well. And a lot of times the most talented people aren't the most successful. And then after that happened, I was like, you know what? I know this business formula pretty well. Like if there's a lot more randomness to this music thing. And so I ended up, kind of going kind of back all in the business and finance world after, really spending some time there. And I love it. I'm passionate about it. I don't spend much time.
Did you play
on
in
it
groups at
personally anymore,
times?
so. Yeah, bands early on. And then, just went more the songwriting and recording route for a while. But.
Yep. Have you listened to Stretch yet? My song?
Oh, yeah. Oh, you know what's funny? Because I ended up on your newsletter list or whatever else. I did listen to it. Yeah.
And?
So, yeah, I mean, it was a compelling song. It was interesting. Yeah. I mean, it was one of those clever, kind of, like, I don't know, country music has that, kind of clever play on, words kind of thing. So.
Yeah. And it's country music because of the subject of the song. It was like, because I wrote it as lyrics, and then Jason Mendelsohn did most of the hard parts from there. But we talked about, like, okay, what genre do we want to record this in? And because country's not, that's not my genre per se. I like it, but
yeah.
And
but
so
it fits the lyric profile.
Yeah, so we got to do it. So you got someone from Nashville to sing it, and he did a lot of the writing of the music. He did a lot of the production of it, and it was purely accidental, but it was fun, and that will be my only foray into your world of music.
See, mine was before everything was quite so public. So if people really did some digging, they might find some old remnants of things out there. But it's it was like before there was the music platforms and everything, where it's like once it's out there, it's out there.
Yep. So let's do one more thing as we wrap this up, and let's look 10 years into the future. You take what you're doing now at Denver Ventures, fast forward over 10 years. What do you think your ideal kind of path or journey will lead you to? Where do you think it leads to you in a 10-year time frame? What do you think you'll be kind of doing, involved with? What does that look like?
Yeah. I mean, I think as an extension to kind of where I left off on this, like ending up here, realizing probably about 6 years ago, there was like, this is it. This is the work. This is the ultimate culmination of all these different things I've done and experiences, and being really passionate about, throwing my weight behind, just realizing there are these truly extraordinary, more extraordinary individuals than I am. And it's like, I can try and compete with them, or I can just throw my weight behind them, right? All my relationships, everything I have. And so as you see that play out over the next, 10 years, I mean, it's pretty cool. You build, the portfolio, and it's like popcorn, it's just like all these different things, kind of popping up and down, and you back more and more of these exceptional founders. And as that plays out full cycle, it's very powerful. We believe very much in the portfolio. We have a great portfolio, and we're only getting access more and more to great deals. So I'm very personally, a big driver for me is I want to return $1 billion of capital to these big base of Colorado investors. I just think like super powerful what we can do, with that as that plays out for the overall ecosystem. I mean, it starts with deploying a lot of money on the front end, but we always have our eyesight at the end of the day. That's really where we'll make our money, and we'll have our impact is on the side where it comes back. So I think we'll keep. There'll be at the seed fund level. There'll be fund 2, 3. Keep going. At the growth stage, we'll probably do some funds as well that play well with the syndicates. We have a few ideas for what type of funds we may launch that make sense in the future. We'll continue to grow our SPV. When I say syndicate, like SPV activity as well on our base there, particularly in the family office side of things. I mean, that's really where I think we've created the most compelling value prop. I mean, for accredited investors, it's extremely compelling because they can piggyback off of our family office space. But we have about 100 family offices in the group now, and a lot of family offices that might put $250,000, $500,000 in a deal. At that size, that's meaningful for one individual company. But at that size, you're going to struggle to get access to like a great batch of companies, right? And so we kind of provide the ability for them to then partner with a few other family offices in an aggregate.
Oh, sure.
We're doing it, and so I think we'll continue to really grow that base as well. That's like, so I'm excited to go build really a big firm that keeps these strong community roots, because that's our unique differentiator. I'm acutely aware that if we just want to be another asset manager, fine. If you want to go compete with the best asset managers in the world, what we can be, I think, unique is the most human way of deploying capital, the community aspect of things that also is world-class and provides really great, return results. But the community side, where we still have this investor membership community and we have, all these regular events, and people feel like they're a part of something and they're contributing to something, and they're not just investing in a fund, though a lot of our investors are. They're also making individual decisions on a regular basis and getting a chance to interact with those founders. And so we think it's a really cool, combination that we is our foundation, and that we are just going to continue to invest more and more back into the community side of things.
Great. Well, it's been great getting to know you, and we've done a little bit of collaboration so far. I think we'll end up doing a lot more collaboration in the future, and we have kind of shared interests in really investing in this ecosystem and building, being part of building great companies and great outcomes, and those in turn will fund other great entrepreneurs. Absolutely. And great outcomes. And I think we have a great thing going here, and I think as long as we all, as a broad community, kind of row a similar direction, Colorado is going to be the place to be for a lot of these really scale-up tech companies. So I'm excited, and it's been great getting to know you guys.
Awesome. Yeah, thanks, Dan.
Thank you.
Appreciate you having us.
Thank you for listening to this episode of The Bear Roars. Check out Stretch, the new song from Dan Caruso, with music by Jason Mendelson, available now on all streaming services. If you enjoyed the episode, please like and subscribe on your listening platform. This podcast was produced by Loud Bear Productions and edited by Kendall Weinberg, with support from Gibson Siegert.